What if I told you that in just a few seconds, trillions of dollars can disappear from global markets, not because of real economic collapse, not because of war, not because of recession, but because of a headline? What if the biggest moves in gold and silver are not always about fundamentals, but about positioning, leverage, and machine-driven panic? This is exactly the kind of environment we are living in right now. And if you are invested in precious metals, you need to understand what is really happening beneath the surface. Welcome to Gold Silver Scope, where we break down gold and silver markets with clarity, logic, and real analysis. Without hype, without fear, and without distractions. Let's start with the recent drawdown. It was aggressive. No one can deny that. In a very short time, markets saw massive selling pressure. A major financial media headline suggested that Russia might move back toward dollar alignment. That narrative alone triggered a wave of reactions. Index funds began forced selling. Margin requirements were increased. Algorithms detected downside momentum. And in modern markets, when algorithms see selling, they don't wait. They accelerate it. Selling creates more selling. Machines amplify it. Liquidity disappears. And within moments, roughly $3.5 trillion in equity value was wiped out. But here is the key question. Was the headline accurate? Later reports clarified that Russia had no such confirmed shift back to a dollar standard. Yet the damage was already done. The positioning had already adjusted. The leveraged players had already been flushed out. This is how modern markets move. Not slowly, not rationally, but violently and mechanically. And let's be clear, this volatility is not limited to gold and silver. Look at the broader equity market. In 2026 alone, major technology stocks have seen noticeable declines. Even the so-called strongest companies have pulled back sharply. At the same time, retail investors have poured record amounts of money into equities. That combination, heavy retail inflows and internal market weakness, is historically not a healthy sign. Here is something even more important. Over just 8 trading sessions, more than 100 stocks in the S&P 500 dropped at least 7% in a single day. That kind of internal breakdown has only happened about 1% of the time over the past 30 years. Yet the index itself is only down a few percent from its highs. That means surface calm is hiding internal stress. Historically, when this type of internal damage appears, it often precedes much larger corrections. The last time we saw similar patterns was around the early 2000s tech unwind. I am not saying history will repeat exactly, but ignoring internal weakness is dangerous. Now add crypto volatility into the mix, add geopolitical uncertainty, add shifting central bank policies. We are clearly in a period of upheaval, and in periods of upheaval, speculation increases. Rumors spread faster, fear travels quickly. This brings us to something extremely important. Misinformation in the precious metals space. In recent weeks, many online voices have claimed that new reporting rules are coming. Some claimed there would be confiscation laws. Others talked about secret regulatory changes targeting gold and silver holders. There were even rumors about specific dates and new forms being required. We fact-checked these claims. There is no new confiscation law. There is no surprise reporting mandate taking effect on a secret date. There is no sudden regulatory trap being set for precious metals investors. These claims, as of now, do not hold up under scrutiny. And this matters because misinformation often appears at critical inflection points. When markets are volatile, emotions are high. Fear spreads quickly, and when fear spreads, weak hands sell. That is how volatility shakes people out. In today's market, algorithms react to keywords, not context. Social media amplifies headlines without nuance. Influencers repeat rumors without verification. In that environment, discipline becomes your greatest asset. You must separate analysis from sensationalism. Even experienced analysts can make mistakes. No one is perfect. What matters is transparency, correction, and commitment to accuracy. In fast-moving markets, humility and due diligence are not optional. They are necessary. Now let's connect this to precious metals. Recent drawdowns in gold and silver were intensified by headline-driven trading and automated de-risking. What looked like fundamental repricing was largely mechanical liquidation. Margin calls forced selling. Funds reduced exposure. Momentum traders exited. And again, selling created more selling. This is how liquidity crises begin. Not because gold suddenly lost value, not because silver became useless, but because leveraged positioning was crowded. When leverage is high and positioning is one-sided, small catalysts create big reactions. But beneath the volatility, something else is happening. Something structural. Now let's move away from headlines and look at something far more important: the actual structure of the silver market. Right now, we are approaching first notice day for a major silver futures contract month. This is the moment when traders who are long futures contracts must decide whether they want to roll their position forward or stand for physical delivery. And this is where the numbers start to matter. Recently, open interest in the upcoming silver contract stood near 58,000 contracts. Each contract represents 5,000 ounces of silver. When you multiply that out, you are looking at roughly 290 to 300 million ounces of silver that could potentially stand for delivery. Now, to be fair, not all of that will demand physical metal. Many contracts get rolled into the next active month. That is normal behavior in futures markets. And in fact, a significant amount has already rolled forward. But here is where it becomes interesting. Even if only half of that remaining open interest decided to stand for delivery, you would be talking about roughly 150 million ounces of silver that would need to be sourced and delivered. Now compare that to registered silver inventory, the metal that is actually available and designated for delivery. That number is sitting around 90 million ounces. Do the math. If even 50% of open interest stood for delivery, the required metal would exceed what is currently registered. Does that mean default? Not necessarily. What it means is stress. And stress in commodity markets does not always show up first in price. It shows up in mechanics. The exchange has tools. They can incentivize traders to roll forward. They can offer cash settlement premiums. They can widen exchange for physical spreads. They can make it financially attractive not to remove metal from the system. This is how pressure is managed. But pressure is still pressure. Even if only 20% of open interest stands for delivery, that would represent around 60 million ounces. That is a very large percentage of available registered inventory. It would drain supply quickly. And here is something even more important. This is happening while Shanghai prices are trading at a noticeable premium over Western benchmarks. When there is a persistent premium in Asia, that signals real physical demand. It creates arbitrage opportunities. Traders can buy metal cheaper in the West and sell it at higher prices in Shanghai. Some argue that value-added tax eliminates the arbitrage. That is not fully accurate. VAT typically applies when metal exits the exchange system and goes into private hands. If the metal stays within exchange vaulting systems, the immediate tax burden does not eliminate the spread. When the premium is wide enough, even with taxes considered, demand continues. And that is what we are seeing. Physical silver is flowing east. This creates a geographic disconnect. Western markets trade heavy paper volume. Asian markets are showing stronger physical demand. When those two systems diverge, something eventually has to adjust. If Western paper pricing stays disconnected from physical demand in Asia, metal will continue to leave London and New York vaults and move toward where it is valued more highly, and stress builds quietly. We are also seeing episodes of backwardation, where near-term contracts trade above longer-dated ones. In precious metals, This is unusual under normal conditions, because storage costs usually create contango. Backwardation can signal tightness in immediate supply. For market makers and bullion banks, this makes hedging more complicated. If sourcing physical metal becomes harder, their short positions become riskier. When hedging becomes difficult, volatility increases. And here's the key point. The market looks calm until it isn't. Commodity stress does not always announce itself loudly. It builds slowly. Inventory drains month after month. Premiums widen gradually. Spreads become unstable. Many investors lose patience because the process feels slow and repetitive. But structural shifts rarely happen overnight. They happen through steady accumulation and gradual drainage. Silver in many ways acts like a pressure gauge. It is smaller than gold. It is more industrial. It is more volatile. When stress appears in the monetary system, silver often reacts first and more aggressively. This is why some call silver the canary in the coal mine. Now let's expand the view. While silver is showing tightness signals, gold is experiencing something even more significant on a strategic level. Central banks across emerging economies have been steadily increasing their gold reserves. At the same time, exposure to long-term sovereign debt has been reduced. According to publicly available data, central bank gold purchases in recent years have been near record levels. That is not retail speculation. That is institutional reserve management. One notable hedge fund manager, David Einhorn, has openly stated that gold is increasingly acting as a premier reserve asset again. When someone managing billions of dollars says gold is replacing treasuries in importance, that is not noise. That is a signal. Confidence in fiscal systems globally is weakening. Debt levels are rising. Long-term macro outlooks are uncertain. In that environment, neutral reserve assets become more attractive. Gold does not depend on a government promise. Silver, while more volatile, benefits from both monetary and industrial demand. As electrification, solar infrastructure, and technology production increase, industrial demand remains structurally strong. So what we are seeing is a combination of short-term volatility and long-term structural strength. The volatility shakes people out. The structure quietly strengthens underneath. Now let's step back and connect everything together. On the surface, what do we see? We see violent drawdowns. We see silver getting smashed in a matter of hours. We see trillions wiped out from equity markets in seconds. We see headlines driving panic. We see algorithms accelerating fear. But underneath that surface, the structure tells a very different story. In silver, open interest remains historically large compared to registered inventory. Even a modest percentage of contracts standing for delivery can drain available supply quickly. That does not automatically mean default. It means pressure. And pressure in commodity markets shows up in subtle ways first. Wider spreads, higher exchange for physical premiums, backwardation, and aggressive incentives to roll contracts forward. We are already seeing signs of these stress points. At the same time, the persistent premium in Shanghai over Western pricing signals something critical. Physical demand is real. This is not just speculative paper trading. This is metal being valued differently depending on geography. When arbitrage continues despite taxes and logistical friction, it tells you demand is urgent enough to absorb those costs. Metal flows toward strength. If Western paper markets price silver too cheaply relative to physical demand in Asia, supply will continue to migrate east. Over time, price discovery itself can shift geographically. That is not dramatic. It is gradual, but it is powerful. Silver feels unstable because it is smaller and more volatile than gold. But volatility does not equal weakness. In fact, in bull markets, volatility is often the mechanism that removes weak hands. All bull markets test conviction. They shake out participants who are over-leveraged, emotional, or short-term focused. They create sharp corrections that feel like the end, right before the next leg higher. Now look at gold. Central banks are not panicking. They are accumulating. Over the past few years, official gold purchases have approached record levels. In 2025 alone, global central bank buying was reported near 900 tons. That is not speculation. That is reserve strategy. When institutions at that level increase exposure to gold while reducing exposure to sovereign debt, it reflects deeper concerns about long-term fiscal stability. It reflects a slow but steady monetary realignment, and that is the key phrase, slow but steady. Many investors expect fireworks. They expect instant collapse or instant breakout. But real structural transitions rarely happen that way. They unfold over years. They build quietly while volatility distracts the majority. Silver, with its delivery tightness and geographic demand imbalance, is showing mechanical strain. Gold, with central bank accumulation and reserve diversification, is showing strategic repositioning. Together, they paint a picture that is far stronger fundamentally than price volatility suggests. Yes, the volatility will continue. Yes, we will see sharp corrections. Yes, headlines will attempt to trigger fear. But if you understand delivery mechanics, inventory math, arbitrage flows, and central bank behavior, the noise becomes easier to filter out. Markets are calm until they are not. And when stress in physical markets finally translates into price repricing, it often happens faster than most expect. That is why discipline matters. That is why due diligence matters. That is why emotional reactions are expensive. If you want clear, fact-based breakdowns of gold and silver without hype, without fear tactics, and without distractions, make sure you stay connected with Gold Silver Scope. This channel is built for serious investors who want to understand structure, not just headlines. Before we close, a short disclaimer. This content is for educational and informational purposes only. It is not financial advice. Markets involve risk, and every investor should conduct their own research or consult a qualified financial professional before making investment decisions. Stay patient, stay rational, and most importantly, understand the structure behind the price.